Complete disaster. Talk about Alternative C. Oh, just wait until you hear about Alternative C. Concerns about how much the market's going to fall. How are we going to handle the triple threat of an energy crisis in Europe, Chinese lockdowns, and aggressive tightening? Like here in the US, are we getting 100 BPs or 75? What do developers have to do with the Federal Reserve, and what new issues does that bring up? And what's all this talk about Fed 2025, as well as, are we going into a recession? Are we in one? Are we going into depression? We are in a synchronous global slowdown, even to the point that FedEx is now warning of a global recession, with prices of cardboard plummeting so much so that homeless in California are finally finding shelter. And no, while that is a bad joke, the bad joke is actually California. But this isn't a political video. This is a critically important video for you to consider regarding the Federal Reserve. And we're going to talk about a lot of what I just teased. 3 very quick notes and we'll get started. If you're an accredited investor, check out HouseHack.com to invest with me and my startup. You get founder shares. Make sure to read the PPM because this is not a solicitation. Number 2, want lifetime access to the courses on building your wealth through real estate or stocks or entrepreneurship? Go to metkevin.com/join. And number 3, this video is brought to you by MooMoo, but more on them later. Now, let's get into some new information. Earlier this week, we received news that inflation had been expanding significantly more broadly than expected, and this is leading to new calls for the Federal Reserve to take an approach known as shock and awe, basically to mini Paul Volcker us. Don't worry if you don't know the Paul Volcker reference. The point is to basically beat us up and raise interest rates more and cause more pain in the markets. And pain in the markets is exactly what we're seeing. And the best way to measure that everything is rising, that prices are broadly going up, which is very dangerous for the Federal Reserve, well, is by doing this. You get a chart that basically subtracts food, shelter, energy, used cars, and trucks, basically almost everything, right? But then it leaves all of the miscellaneous items, and what do you have? You have inflation that is still rising. And that's kind of scary. And so it's leading to a lot of talk that on September 21st, the Federal Reserve is going to beat us up with a 100 basis point hike. A 100 basis point hike in interest rates is a 1% hike, and it has not been done since the 1980s when Fed Chair Volcker essentially rug pulled markets and raised interest rates above the level of inflation. Right now, we're at 2.5% in interest rates and inflation is 8.3%. Imagine bringing rates above that. It would cause massive panic. And panic is exactly why a lot of folks are saying there's no way the Fed is going to do a 100 basis point hike. See, you have to remember this. The Federal Reserve works through words. They do very little in the way of action that is unexpected. In other words, when they want to do something, they send a quick little text to the Wall Street Journal and leak it. And they use words or speeches or TV appearances to basically coax the market into expecting what the Fed wants. So if the Fed wants to pause, they start leaving those hints, the market picks it up, the market rallies. If the Fed wants the market to cool and relax, they start leaving hints that more tightening is coming. And that's exactly what we've gotten, because as this last inflationary report showed more broad levels of inflation, we're now expecting with almost certainty that we're going to get at least a 75 basis point hike. Presently, markets are pricing in an 83% chance that we're going to see a 75 basis point hike. But what about this idea of shock and awe, that what we really need to do is just rug pull the market and make sure we raise rates immediately with a 1% rate hike so that way the Fed can finally restore some of its credibility, because clearly they've fallen so far behind inflation that anything they do is too little. And there are individuals who argue this on both sides ad nauseum. In fact, you have individuals like Cathie Wood and Elon Musk chiming in on this, and this gets quite interesting. Here, Cathie Wood replied to Elon Musk, who 6 days ago wrote, "A major Fed rate hike risks deflation." And now this is a really interesting argument because clearly we're in a situation of broad-based inflation right now. Why would Elon Musk say we risk deflation? And where's Cathie's head on this? Well, first, the reason Elon suggests that we might risk deflation is, and this is really, really weird, but every time the Fed does something, it's kind of like they're taking a rope and whipping that rope. And so the motion of them whipping the rope by raising interest rates looks very small at this end. It'd be about, maybe a 12-inch move here, right? That looks relatively small. But at the end of the rope, that could be whiplashing at, a 3-foot or 6-foot distance. The point here is to say that over time, the impact of the Federal Reserve's actions are really amplified. So if they want to have a small impact at the other end, they got to do small strokes, right? And this becomes really important because what Elon is alluding to is the fact that if the Fed goes too shock and awe-ish in the short term because they're trying to convince markets, no, we still have credibility, don't worry, we're over, inflation is transitory, it's okay, we realize we messed up. It's kind of a mix of Janet Yellen and someone else, I don't know, leave a comment down below. But anyway, then sure, the Fed would get credibility now, but they would cause so much tightening over the medium to longer term, the next 6 to 24 months, that we could actually push our entire United States economy into a depression. At that point, you would forget about recession. You would be in a depression. And if you're in a depression, well, now guess what the Fed has to do again? Take out the money printer again, and send stimmy checks again, because they've over-tightened on the economy. And it's really important to know that we don't want the Fed to go hard now because they're going to wreck us in the future. And this is why we haven't seen the Paul Volckering yet, right? Raising rates to the level of where inflation is, because we expect inflation is trending down. And this is exactly what is typified, or exemplified, I should say, by Cathie Wood, who, by the way, follows me on Twitter. Follow her as well. Shout out to Cathie, super honored. But what we got here? Deflation is in the pipeline, says Cathie Wood. She says that the heading for both the producer price indices, the consumer price index, the personal consumption expenditures deflator, which is basically the CPI version that the Fed uses. It's pretty similar, small differences. Anyway, from post-COVID peak prices have resulted in lumber being down 60%, copper down 35%, which is an industrial metal. When this falls, we tend to indicate that we might be going into recession. Oil down 30%, heavily because of China. Iron ore down 60%, also heavily because of China. Less real estate development in China means iron ore goes down. DRAM down 46%. That is an index that tracks chip prices for memory cards. Corn down 17%. Baltic freight rates down 79%. This is true. Container prices have collapsed, but they're still way higher than they were before the pandemic. Even though we went from like $20,000 a container to like $6,000 a container from China to the United States to like California or Long Beach, it's still like 3x what it used to be, which would be like $2,000. So even though 79% sounds like a big drop, it's still kind of like, oh dang, we still got problems. Like, hey, gold down 17%, silver down 39%. Okay, got it. Now, Cathie Wood does continue her discussion a little bit, so we'll just quickly take a look at this. As measured by the Manheim Used Index, we see used car prices down 4%. That's about a 50% annual rate. What she did there, she just multiplied 4% by 12, right? And they've dropped 10% since peaking in January. Now, she is using this as a way to suggest that electric vehicles are causing this disruption, when in my opinion, the reality here is that used car prices just exploded because there was a shortage of cars after we started reopening in 2021, shortage of chips to manufacture new cars, so used cars became more expensive. So I can't really pin this solely on electric vehicles, even though I want to, okay? And then she talks a little bit more about this, which of course Elon Musk replies to, exactly, this is neither subtle or a secret, all of this happening here. So anyway, okay, so all of this is to say that on one side, yes, you have people who say Fed be credible. On the other side, people say, but if you're too credible, you're going to wreck our economy. Don't do it. Our economy in the United States is still really strong. Don't destroy that. Retail sales numbers were just revised up for last month. The consumer has more money than they did before the pandemic. Yeah, consumer credit expend is going up, but consumer savings are also rising again following a dip in the summer. So you're kind of in this really remarkable place where America is actually really, really strong. And we're not really facing this potential apocalyptic crisis in the United States, but we do face this massive anchor of both Europe and China likely going into a very deep and extended recession, if not depression, which on one hand is actually good for inflation because less spending over there, whether it's on energy products or just materials in general, will help bring inflation down. It's actually kind of like Europe and China could be the anchor to bring inflation down in the United States. Think about that for a moment. Pretty remarkable. Now, there are some really important things that we have to consider about this 100 basis point hike, including something that has to do with developers. And we're going to talk about that because it's so critical. Right after I mention our sponsor for this video, and no, this time it's not me with the courses linked down below and the programs on building your wealth, which are amazing with me in the private live streams. Every day the market is open. It is from MooMoo. Oh, hey, have I told you about an amazing stock trading platform called MooMoo? MooMoo offers countless amazing features that help you take your trading game to the next level. Sign up in my link down below, and you can get up to 13 totally free stocks when you sign up using my link down below. On top of that, you'll get one exclusive Bank of America stock when you complete a net deposit of $2,000 for the first time in December, and only when you sign up using my link down below. Now, what's really cool about that, folks, that's 34 bucks totally for free on top of the other stocks that you'll be getting. Check it out, link below. So now let's talk about the Fed and real estate developers. Okay, this is a new one, and this is really cool. So here's the thing that happens. When the Fed raises rates very aggressively, what they actually do is they increase the price of wholesale credit lines for real estate developers. Basically, it gets harder for real estate developers to build stuff, okay? That reduces building starts, which, what numbers have been coming in under expectation and poorly recently? Building starts. In other words, builders are building less homes. And when you build less homes, you reduce the availability of the housing stock. This has a double effect for the Fed, which is extremely important. The first is obvious, and the second one is more important. Let me just get the first out of the way, okay? Because I know what you might already be thinking. The first is that obviously if you reduce inventory for sale of housing, you could potentially increase prices for housing, right? Potentially. But this is more than offset by the fact that mortgage rates have risen and removed about 35% of buyer purchasing power from the market, and it's why home prices are actually trending down now, not up. We're already down 5.5% nationally. We'll probably be down 10 to 15% or more by March and April of 2023, and that's probably when the real fear is going to happen in the housing market. So be prepared for buying deals in the second half of 2023 and 2024, and that's exactly why I'm launching HouseHack, which is expecting to scale my famous wedge deal model, and to hopefully a multi-billion-dollar business to compete with the likes of American Homes for Rent, Open Door, Redfin, and Invitation Homes. And I have good news for whether you're accredited or not. If you're an accredited investor, you can invest today at househack.com, and we're starting the process to make sure we can get non-accredited investors involved as well. So if you're not accredited, don't worry, just stand by. I'm listening to all your comments. I want to get you involved on this, so just stay tuned. That's about a 5-month process. It's really hard with the SEC, but we're working on it. But the more important danger out of all of this is actually what happens to potentially rents with developers. See, when developers build less homes and there's less available rental property stock, then we push inflation onto rents. Not only do we push inflation onto rents when developers are able to build less homes, and so we're pushing up rent prices, but you also push up rent prices when less people can buy homes because now they're renting. So you have less people buying, more people renting, and then less homes available for rent. Another reason prices for rents go up, and this actually drives inflation up. Inflation by rents, right? And the biggest contributor to inflation is housing, anywhere between 25 to 32%, depending on which measure you're using, CPI, PCE. It's a big problem. So, rental inflation going forward is a big deal. And because of this developer credit line issue, you potentially have the Fed looking and saying, you know what? We need to stick with 75. Let's not go for 100, because if we go for 100, it's going to be too big of a whiplash, and we're going to push us into depression, and we're going to be causing other problems like the rental problem. Now, keep in mind, the Fed could make the decision that at some point in the future, they have to restore that credibility. Inflation is just not trending down, and they'll give us the big one. In fact, remember, in January, we were talking about, oh man, is the Fed going to do 0 or 25 in March? We got 25. Then 50 became the new 25, then 75 became the new 50, and then now we're talking about 100 as if it's going to become the new 75. So while anything is possible, we've not had a 100 basis point hike since the 1980s, and I don't really think it's likely, at least not at this point. It's only about 17% likely, but markets are already starting to price this in. And this brings us to part 3, retuning the curve. See, the Federal Reserve has a terminal federal funds rate expectation right now of about 3.75 to 4%. That means at some point in 2023, we expect to get to about 3.75 to 4%. Well, what if that ends up being higher when the Federal Reserve next releases their next summary of economic projections, which is coming out on September 21st? And guess what? In that summary of economic projections, we're going to see what the Federal Reserve thinks their terminal rate is going to be. That new SEP will also project all the way into 2025. It is the first SEP that projects into 2025. Right now, markets think the Fed's going to be at 3.75 to 4%. However, if that terminal rate comes out to be higher, we could see some depression in stock prices. If the terminal rate ends up coming out to be something even higher in the long term, we could see even more pain to stock market pricing. In fact, let me give you a little bit of a guide and clarify a little bit of what I mean by just showing it to you. So this is a chart of the NASDAQ. And what I believe is that where we sit right now with this temporary pain is markets actually starting to price in the potential risk that the Fed is going to increase their terminal rate. So I think where we sit right here at QQQ 288 is roughly equal to about a 4.25 to 4.5% terminal Fed rate. I think over here was an overextension, this 270 level-ish for QQQ NASDAQ, right? I think that is more similar to like a 4.75 to 5% terminal Fed rate. And I think that this yellow line over here is representative of a Fed wanting to be around 3.5 to 3.75 and then U-turning down soon into the future. Now, the problem with the Federal Reserve U-turning and this idea that they're going to pause and U-turn is that I actually personally don't believe that the Federal Reserve is going to U-turn anytime soon. Keep in mind when I say personally, I say that because even though I've passed the financial advisor test and I'm going to be a licensed financial advisor within the next few weeks, or at least I expect to be, I can't give you financial advice. So when I say something's my opinion, it's coming from, in my opinion, a great place, but it's just an opinion. I could be wrong, right? So what do we have right here? Well, this right now represents the expectation of the market today. And it's that the market thinks that we are going to see the terminal rate be about 4.5% right here for the federal funds rate, 4.5%, and that the Federal Reserve will start reducing interest rates in May of next year. I personally do not believe that'll be true. I personally believe the Federal Reserve will actually maintain this position for much of, if not all of, 2023. And even if that extends to November, this difference that you see over here in purple on the right side there, that difference will mean there's going to be some more pain that we have to price in. So we'll have to flatten this out. You price in more pain to the market. So very quick summary, okay? Market right now is expecting a terminal rate of 4.5. I want to update that from making sure I clarify that from what I said earlier. 4.5 is the current terminal rate. You could write that down. The terminal rate goes up, expect the QQQ to go back to 270. 4.5% terminal rate, QQQ 290. 4% terminal rate, QQQ maybe 320. You can write those things down. You can't take them to the bank because they're just words, but you could write them down because I think they're a useful guide for what we could be faced with. But what's most important going forward here? Sure, we're going to get this SEP. We might even get some phraseology that says things are going to be higher for longer, some signaling from the Fed that things are going to be restrictive for some time. But what's most important are the following two things. Markets' expectations of inflation measured by these two charts. Number one is this. This is a chart of the 5-year break even, which gives us a chart of people's emotions, their expectations of what inflation will do in about 4 months. Notice how this peaked in March, and we got peak in about June and July in terms of inflation. So you can see that peak was correct. It shows up in the reports later. Well, if that remains to be true, which historically it has been, then we should see inflation trend down very, very nicely. In fact, I'm just going to hide myself for a moment. Look at this. Even with the latest drama over the last few weeks, the 5-year inflation expectations are going down, not up. They're volatile, they're bumpy, but they're going down and not up. And on top of that, we just had a University of Michigan release this morning that suggested that Inflation expectations for 1 year stayed stable at 4.6% as expected, but we had an unexpected drop from 2.9% for 5 to 10 year inflation expectations down to 2.8. So, if you're an investor who's investing based on expectations of inflation, which are very, very powerful, you don't have to, in my opinion, worry so much about Alternative C. Alternative C is the presentation that is known as the hawkish presentation that is given to the Federal Reserve at their meetings. A is generally dovish, B is generally neutral, C is generally hawkish. Right now, Alternative C appears to have a 17% chance, and if you believe in expectations, as the Fed does, we're probably not going to have to worry about Alternative C. Instead, in the United States at least, we're going to be dealing with a paper recession. Now, you know me. I've been talking about this potential for a paper recession since January. And while I don't do things perfectly, I've been talking about this paper recession coming and talking about how, in my opinion, when we look back in a couple years, we're gonna go, dang, wish I invested more during that recession into the stock market. But don't worry, you'll have time to get into real estate because that pain's coming in 2023 and 2024, maybe even into 2025. And while this is not a solicitation, the PPM is, make sure you go to househack.com to consider investing with me. And click the link at the top of the comments and the description down below to sign up for the Investor Q&A live stream we have coming up this Sunday. Thanks so much. Goodbye.